Our October read on retail sales up 1.3%. That is definitely better than expected. You have to go all the way back to February to find a better month-over-month change. If strip out autos, still up 1.3, solid. Strip out autos and gas, it deteriorates, but not by much, up 0.9. These are multiples of what we expected. And the control group to be inputted in higher up the food chain economic releases, well, that number is up 0.7%. Up 0.7%. That is the best level since June when it was up at 1.1. Very solid. Now let's switch gears, shall we, to October import prices. Month over month, down 0.2, which means that down 0.2 is the fourth negative month in a row, even though it is the smallest, and it is less than expected. We were expecting a number closer to down 0.4%, so down 0.2. Strip out petroleum, it is also down 0.2. If we look at import prices on a year-over-year basis, they were up 4.2%. That's darn close to expectations. And if we look at import prices on a year-over-year basis with respect to any revisions, don't see any. In the last look, it was up 6%. The high watermark here was up 13% in March. Big progress. Export price on a month-over-month basis, down 0.3% as expected. A bit of a revision, though, in the rearview mirror from only down 0.8 to down almost double that at 1.5 in the rearview mirror. And finally, export prices on a year-over-year basis expected to be over 7% are under 7% at 6.9%. And last month's 9.5% is downgraded to 9.2%. High water mark there, 18.6% in both May and June. So pretty good progress. Here's the issue. If you looked at 10-year note yields, they popped just a little bit before the release of the numbers, so a whisker shy of 3.79%. As you can see, they basically have hovered there. So after a pre-number pop of a basis point or two to the upside, it remains rather tame. We are all looking at the psychological area of 3.75%. And, of course, we know the high water mark is still right around 4.25 on a closing yield basis. And that is a far cry from some of the 5% handles many have been nervous about. Becky, back to you.
All right, Rick, thank you. Let's bring in Steve Leisman. He's got more on this right now. Steve, what do you think?
This is a stunning report for an economy that's supposed to be going into recession, for a consumer that's supposed to be weakening and otherwise being at the edge of their skis here. When I look at this report, I see nothing but positives, Becky. When I look down the list, there's a couple negative numbers out there, but let's just go through it because it's really fascinating. Furniture and home furnishing stores. Remember, we're supposed to have a real estate problem? Well, up 1.1%. And I think Diana Olick later today is going to talk about people remodeling their homes instead of moving. Autos up 1.3%. We've talked a lot about this. The auto sector is supposed to be one of the most interest rate sensitive sectors. But remember, we came into this period of time here being below where we should have been when it came to car sales because of the chip shortage. So now we have a rebuilding auto sales sector here at a time when the economy is supposed to be slowing. It is not in that regard. And all of this happening while the consumer spent 4.1% more for gas at gasoline station sales. So I don't know if this is just a rebound from the goose eggs we got in September, but certainly this is positive, and it's positive on an inflation-adjusted basis as well if you use the October CPI to deflate these numbers by. So hard to see too much stress. We did get some sense of stress yesterday in the New York Fed survey of household debt, and they did see people relying more on credit cards to make purchases. That's something to watch. But certainly this number is going to flatter fourth quarter GDP and moves us further away from any sort of perceived slowing if the consumer is doing this well, Becky.